Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome back to another exercise tutorial from our tutorial series of chapter 3 from the Managerial Accounting course ACCT 428. This is Muhammad Al-Jabir, and in this video tutorial we're going to be looking at exercise 3-9A. So let's read the exercise together. It says, ASCII Enterprises produces a product with fixed costs of $200,000 and variable cost of $9 per unit. The company desires to earn a $100,000 profit and believes it can sell 20,000 units of the product. What's required here? A. Based on this information, determine the target sales price. Notice how this exercise is different from what we've done so far. Here we do have some inputs, so let's highlight them first. Here we have the fixed cost 200,000, the variable cost $9 per unit, and we do have a target profit, okay, and we do have the quantity. The only thing that is missing from the data given in the question here is the price. So going back to our formula, remember that we use sales minus variable costs, total variable costs, let's call that T, okay, minus total fixed costs, okay, equals profit, right? And we typically break down this term right here, the sales term, into price multiplied by the quantity, which is N, minus variable cost per unit multiplied by the quantity, which is N, okay, minus the total fixed cost, and that should equal the profits. Normally, we do know this and this and this, and we know that at the break-even point this is equal to 0, but here we know the quantity and we know everything else, but we don't know this price right here, okay? So we're still going to be using the same formula. The only thing that is going to change is that the unknown term is different. So we need to play around with our formula a little bit in order to find the missing value in this case, which is the price. The price is unknown, so we'll just assume that it is P, okay? However, we do know N, which is 20,000 units right here. So we'll multiply P by 20,000 units minus the variable cost per unit, which is $9. So we'll multiply 9 also by the quantity, which is 20,000 units, minus the total fixed cost, which is $200,000, should equal the desired profits, which was given to us in the question to be $100,000. Okay, now just go ahead and simplify everything, and we'll keep the term with the unknown value to the left side of our equation and move everything else that we know to the other side of the equation. Okay, of course changing the signs, right? So this P multiplied by 20,000, this is going to be 20,000 P, we'll keep it as it is, equals 9 multiplied by 20,000, that's going to be 180,000. Remember, because we're taking this across the equal sign to the other side, we're going to change this, so this is no longer going to be a negative, it's going to be a positive, okay? The same thing applies for the fixed cost right here, the total fixed cost, so this is going to be plus $200,000, okay? And this is going to stay as it is, so plus $100,000. Okay, that's it. We're almost there. Now we just simplify everything. So again, this is gonna stay as it is for now. 20,000 multiplied by P. It's gonna equal 180,000 plus 200,000 plus 100,000. Okay, and that's gonna be 480,000. Okay. Now, of course, we want to set this free, so we're gonna divide both sides by 20,000. Right? And we should get our answer. So P should equal 480,000 divided by 20,000. And that's going to be $24 per unit. So the price that the company should set for the product is $24 per unit. And that's the answer to part A. Now let's read part B. It says, assume a competitor meaning يعني شركة منافسة, is currently selling a similar product for $20 per unit, meaning that they're selling their similar product for cheaper than the price that our company is charging. Okay, so explain how ASCQ can use target costing to maintain its desired profitability. Okay, now this is something that you can answer yourself. The company, the simplest way that the company can maintain their desired profitability without changing too much in their quantities, the amount of product that they need to sell and so on, is that they can maintain their contribution margin. Okay, so if they want to be competitive with their pricing, they probably would need to reduce this price from 24 all the way to $20 per unit, right? So to be similar to their competitor. But if they do that, their contribution margin is going to shrink. Remember, the contribution margin is the selling price minus the variable cost. So what's the solution to that? How can they maintain their contribution margin, reduce their price, but maintaining their contribution margin? Is that they reduce their price, but also manage to reduce their variable costs. Okay, so their variable cost right now is $9. So if they want to reduce the price by $4, they should figure out a way to also reduce their variable cost by $4. And that will keep their contribution margin the same, which in turn is going to keep their profitability as it is. Okay? So you can put this in words, whichever way you find useful. We could say, for ASCQ to remain competitive, they should find a way to reduce their selling price without reducing their contribution margin per unit. They can achieve this, by reducing the variable costs per unit by the same amount they reduce their selling price. Okay? Because again, something like this you can put in your own words. You can even write it down as a formula if you like. So currently the company has their, remember, the contribution margin per unit equals the price minus the variable cost per unit, which in our initial scenario is equal to $24 minus 9, which is equal to $15. Okay, so if they keep this constant, their profitability will not be affected, right? So what they can do is, because they need to reduce this by $4, so it will become $20 minus variable cost. We don't know how much it's going to be yet. Should yield the same contribution margin, which is 15. Okay, and if we solve this for the variable cost per unit, that's going to be 20 minus 15 equals the variable cost. Okay, thus the variable cost should become $5 per unit. Okay, that's what we're trying to say. I hope that it is clear, and I hope that you found this video tutorial useful. This is how we solved exercise 3-9A. If you still have any questions, as always, feel free to drop them down in the comments, and I'll try to respond to each and every comment. This was Mohammed Al Jaber. Until I see you in the next exercise tutorial, keep on learning. Take care.